And the next question asks you to calculate GDP in yet another way. In a lecture which we've had last week, I've explained the circular flow diagram, this diagram. And if you haven't seen this lecture, this video lecture, please have a look, because it explains how exactly the circular flow diagram was constructed. It might look quite complex, but in fact it's not if you follow me step by step, how exactly I've drawn it. And in this diagram, I explain why exactly GDP is equal to national output, is equal to national income and national expenditure. I explain how exactly they measure absolutely the same thing. They measure the same flow which goes through the economy, but at different parts of this flow, at different points. For example, if you imagine that this is the circle of flow of money and flow of goods running through our economy, we can measure the size of this flow here as a total value of output produced, or here as national income. So we measure the same flow but at different points, or here as national expenditure. And because we measure the same thing, they're all equal to each other. So please pay attention to this lecture. And in next exercise, exercises 8 and 9, we are asked to calculate GDP using a different method by relying on the formula for aggregate demand. So generally, aggregate demand is the most important concept in macroeconomics. You will need to memorize this formula. It's the critical, most important formula. Of course, in the exam, you will be able to refer to your notes, you will be able to see it, but you need to understand it, you need to absorb it to be able to understand the rest of the logic of this course, because it explains so many things, as you will see. So aggregate demand consists of several components: consumption, investment, government expenditure, and net exports. Net exports is the difference between exports and imports. Your circular flow diagram topic will actually explain how exactly it's constructed. What is important is that aggregate demand actually determines national output. It determines total production level in the economy. Why is that? If you plot the main macroeconomic graph, if you plot national output on GDP or national income and expenditure along horizontal axis and price level along vertical axis, you will have your aggregate demand curve, aggregate supply curve, and some equilibrium, macroeconomic equilibrium. This equilibrium, interception of demand and supply, aggregate demand and aggregate supply, will determine equilibrium national level of output. So national output or GDP. Aggregate demand determines total output, total production level. And as it determines national GDP production level, it will determine employment level as well, because number of staff we need to produce certain output depends on the output we want to produce. The highest national GDP, the highest total production, the more staff we will need, the higher employment level will be. And this also determines unemployment level, because the higher the employment, the more staff we employ, the less unemployment rate we will have. And apart from this, equilibrium, which depends on the location of aggregate demand curve, will also determine price level in the country, equilibrium price level, in other words, inflation rate. So strictly speaking, aggregate demand, the location of aggregate demand curve, which depends on these components of aggregate demand, will determine the rest of other macroeconomic variables. The higher aggregate demand is, the higher national output we will have, the higher employment rate will be, the lower unemployment we will have, and also the higher inflation we will experience. The location of aggregate demand is critical, it's important, it determines the national output level. That is why this is the most important formula in macroeconomics. And in the next two questions, you need to apply this formula and calculate GDP based on this information. You calculate national output, Y, yield, total output produced, depending on the components of aggregate demand. So please, if you can focus now on exercises 8 and 9. 8 simply refers to the formula and asks you a very simple question about variables which contribute to GDP. And question 9 asks you to do the actual calculation. There will be different figures here, data set with some numbers which are not relevant. So your task will be to ensure that you pick up the correct variables with correct signs in order to calculate GDP. So please do this now, let's say 5 to 10 minutes to these two exercises, exercises 8 and 9, please. Even if you make a mistake, that's fine. I still want you to come up with a number. Right, let us start with exercise 8. Very simple question based on the formula. So we refer to our formula for aggregate demand. It's consumption plus investment plus government expenditure plus net exports. And net exports is the difference between exports and imports. right? And let's just see which variables out of those which are listed here are not appearing in our formula. Government expenditure, yes, it does appear here. Exports, yes. Exports is a part of aggregate demand. Purchases by foreigners, what we manage to sell abroad, contributes to our aggregate demand. The higher the exports, the more we're able to sell, the higher is demand for our products. Consumption, yes, consumption is the biggest component of aggregate demand. It amounts to approximately 70%, 2/3 of total aggregate demand. Savings, no. Savings is not a variable which is contributing to aggregate demand. In fact, savings is a form of withdrawals, which was the question 1 in this particular seminar, which we have skipped, and you will be able to see the answer to this question online on Moodle. So generally, the whole idea is that there are different injections and withdrawals which would add or reduce the size of our circular flow. The more we produce, the higher is the amount of goods and services fluctuating throughout our economy, the higher our GDP will be. And there will be some factors, some events, some flows which will add to this total flow. This will include investment, government expenditure, and exports. The higher the amount of investments in the economy, the more we will be able to produce. Investment is a component of aggregate demand. Companies which are willing to purchase, for example, machinery to build roads will contribute to aggregate demand, right? If we invest in infrastructure, if we want to construct a road or a new railway, we will buy lots of building materials, we will buy machinery, equipment, we will hire staff, we'll create jobs. This will contribute to our aggregate demand. It's an injection to our total output. We will be able to produce more when companies are willing to invest. Government expenditure works in a similar way. It's a component of aggregate demand. The more government expenditure we have, the more public goods and services the government provides, the higher will be total demand for our goods. What is government expenditure? How government spends its money? It's not just the amount they distribute to support unemployed, for example, or socially vulnerable. No, government provides direct goods and services. For example, they build hospitals or schools, and in order to equip these hospitals, they need to buy lots of medical equipment. They will buy these products. In order to equip schools, they will need to buy lots of computers, stationery, whiteboards, etc. So the more services government provides, the more public goods they provide. Even if they want to have a firework on a bonfire night, they will need to purchase these fireworks. They will need to spend, and as a result, the total demand for our products will be higher. It's an injection to total flow of goods and services in the economy, to total demand. And exports is a form of injection too. The higher the exports, the higher aggregate demand will be. And there will be 3 flows which will reduce the total size of the economy, the total size of the economic pie which we produce. Withdrawals or leakages. This will include net savings, taxes, and imports. Imports, it's quite easy to understand because the more we import, the more we spend abroad, the less domestically produced goods we will purchase, right? And as a result, the more we import, the lower demand will be for our own products, which will reduce our economy. Taxes work in a similar way. It's a leakage, it's a withdrawal from the circular flow, because the higher the tax rates, the more we pay in taxes, the less we'll have to spend on our goods. Our disposable income depends on taxes. Disposable income is the difference between your gross income and taxes you pay. If your job contract states that you will earn 25,000, it doesn't mean that you will receive 25,000, because you will need to pay your taxes, your income tax, your national insurance contribution out of this, and you might get something like 18 or 20,000 only, your net disposable income, which will end up in your bank account, which you will be able to spend. The higher the taxes, the lower the disposable income, the less consumption expenditure consumers will be able to afford, the lower total output, aggregate demand in the economy. Taxes represent a form of leakages from the circular flow. And savings is another form of leakages, because the higher the savings, the lower the consumption will be. Our income can be spent in 2 ways. We've received certain income and we can distribute it, we can allocate it between consumption and savings. When we've received £1,000, for example, we can decide to save, let's say 100, and spend the rest. The more we save, the less we spend. The lower consumption will be if savings rate is higher. So when we increase our savings, when we put some money aside, we don't spend, and as a result, this reduces the total flow of money and goods circulating in the economy. It reduces our aggregate demand. So net savings is not a contribution towards the demand. It's the other way around. It's a leakage. And it's not appearing in our formula for aggregate demand. The more we save, it's a paradox of savings. The more we save, the less aggregate demand will be, the less we will be able to produce in the short run, the lower current output will be. But strangely enough, the more we save, we will produce less in the current period, in the short run, but we will be able to produce more in the future. Because strictly speaking, if we don't save anything at all and we just spend everything, it will boost current output, but it will reduce our future production potential. Because in the future, we'll need to invest, we'll need to replace all obsolete machinery, all equipment which we are using, all our capital which we have will become obsolete at some stage, and we need to keep replacing it. It will depreciate, it will lose value, it will become just outdated. We need to keep replacing it. We'll need to keep investing in our economy to be able to maintain the size of our economy. And if we don't save, there will be not enough funds for these investment purposes. Because basically, when we invest, we borrow funds which someone has saved, which someone has put aside. So banks will act as intermediaries between savers and borrowers and investors. So generally, we save, some group of population saves money, banks accumulate these funds and provide these funds to those who need them for their purposes, for business loans, to buy something, and so on. The less we save, the less funds we will have for future investment. It's a paradox of savings. Higher savings rate will reduce current output, but will boost future output, and the other way around. It's quite interesting. But in any case, the answer to this question is very simple. Savings, D. Savings are not appearing in our aggregate demand formula. And exercise 9 asks you to apply this information and to calculate the actual output. So we need to calculate GDP at market prices. GDP will be equal to aggregate demand. It will be calculated as a sum of our components of aggregate demand: consumption, investment, government expenditure, and net exports. So what is consumption expenditure? This one, 725. That's consumption. Investment. There are two variables here which represent investment: gross capital formation and changes in inventories. That's our investment. Why do we include two of them? Because gross fixed capital formation represents direct expenditure on capital equipment by companies. For example, they buy machinery or production line in order to produce some goods and services. While changes in inventories represents accumulation of raw materials and semi-finished products which they will use in the future. It's a form of their assets, it's a form of their capital. They need these inventories for future production purposes. For example, we expect lockdowns, we expect disruptions to our supply chain, but we want to keep producing our desks. So we might accumulate some amount of worktops, screws, and legs in order to maintain smooth production. It's a form of investment into our future production. So investment will include these numbers, 175 and 4.2. So this will be our investment. Next component of aggregate demand is government expenditure. Government expenditure is shown here by this number, 231. That's government expenditure, right? And the rest, the remaining components, exports minus imports. Let me draw them nicer. Exports minus imports. Exports, 282. That's exports. Imports, 313 imports. So if we combine them, exports minus imports can be recorded as 282 minus 313. Imports will appear with the negative sign here. So we are adding this to the rest of our formula. We add exports and subtract imports. And as a result, we will have 1105.9 billion. So this will be our GDP, a sum of consumption shown in blue, investment shown in green, government expenditure shown in red, and trade with the rest of the world, net exports shown in gray. Sum of all these four components will be equal to 1,105 billion pounds.